Hello everyone, here Chris Capre, SecondSkiesForex.com. Anyways, so let's go ahead and begin today's class, which is on price action trading. I hope you all are having a good day, and I hope you guys are having a good week so far. Hopefully you are. Hopefully trading's been also going well for you as well. And if we have anybody that's new in here to this class, we have a good size group today. If we have anybody that's new in this class here, go ahead and let us know. Let me know. I want to know if this is your first time here, and if this is your first time, to anything on price action. So maybe it has, maybe it hasn't. Pepperoni. Nice. Good name. So welcome. Austin, welcome to you as well. Good. Thank you for coming. Good to have you here. We do have a lot of people here, as I can see the names, that have been coming for a while. And for those of you that keep coming back again and again and again, it's always great to see you guys. The process of learning how to trade successfully, the process of learning how to do anything successfully is one where you have to keep coming back. You just keep coming back and doing it again and again and again. And I know it's nice and convenient to think of, when you think of trading, to think about it as, well, you see so much opportunity here, and there's so many pips moving, and there's so many pairs, and if you can just get the right direction, on, a couple good trades a week, you can make a lot of money, and keep doubling my account, so many times it'll go to the moon and all of that. That's a nice, fluffy version of reality. But, the bottom line is, it would be nice if all endeavors were that easy, if all endeavors were just these things that we could just do a little bit, study very little, and be very good at. Yeah, there may be a rare natural talent out there, but even the best of rare talents have to work really hard to become successful at these things that they become successful at. Mozart, considered one of the greatest, regarded as one of the most amazing, composers of all time. He's very famous for composing his first symphony, at such a young age. But the funny thing is, his first symphony wasn't that great. It took him a good dozen years of practice before he wrote and created a piece that was really significant and something that was remembered. Nobody really talks about it, really says, oh, his first piece was amazing or anything like that. But his other pieces are the ones that are coming on. Those are the ones that he created after years and years of practice. Trading is the same thing. The trading is no different. I'm not saying that you're going to have to do this for 12 years before you can, have a masterpiece of trading set up before you. It all depends on your individual aptitude, and that's only a small portion of it. But it also depends on how hard you work, how much you study, how much you practice, how disciplined you are, how much you practice being disciplined. And so, by keep coming back to these classes again and again and again, you put yourself in a situation where you really can understand what it takes to become a professional trader, and hopefully find a method that is useful, something that you can easily implement, something that you can pick up, and something that just makes sense to you naturally. You'll know when you found the right method, when it just kind of makes sense to you intuitively or naturally. When you look at it and you're like, wow, I really want to learn how to trade that because it just seems to fit me well. And maybe price action is that, and maybe it's not. Maybe it could be Ichimoku or something else like that, and that's fine. It's not really important so much what the style and method that you use is. The most important thing is you find something that's natural to you. Kind of like, as I'm learning to shoot archery, I'm doing competitive archery now, and I'm training now in Olympic techniques. I have to learn a certain technique that's correct. But I also have to learn to shoot with a particular bow and particular equipment that is most comfortable to me. And there's many different options out there, and there's many different ways that they shoot. And you wouldn't think so, but they do. They all have different ways of shooting, different speeds, different pressures, different styles, different feels, different feedback. And so that's all very critical. And so hopefully, this will become one of those, and hopefully you'll learn something from this. But no matter what, keep coming back to these classes, because It's that continued coming back again and again and again that's going to help you build a discipline that will carry into all aspects of your trading. And, trading is not just about learning a method. That's like such a small portion of trading. Trading goes so much more beyond that. And it's about building a certain set of habits that set up the likelihood of your success or your failure, depending on what habits you set up. So with that being said, I want to spend some time, and I'll get into Jawbreaker, I'll get into your question a little bit later on. It's a great question. I'll answer right now since we're on the subject. Have I ever read the book Talent is Overrated? I have heard of the book, haven't read it, but I know the main concepts of it, and there are many books like that. And I agree with the book that, individual talent is absolutely nothing if you don't really learn how to properly use it. And there's so many people that are highly talented that don't ever use it. There's some people that are highly talented that never actually achieve what they could have achieved. And so, with that being said, I think it points to the most critical thing about trading, which is that your discipline, your focus, and the habits that you build is what will more than likely carry you to a successful trading career, which you all probably desire, whether it's to trade full-time or part-time, or maybe you like your job, maybe you like the work you do, you just want to do this part-time to supplement your income, or maybe it's something you want to do full-time. Maybe you want to work from home all day. A lot of people do, but maybe trading something that you want to do, or maybe you just want to do it a few hours a day. Whatever that is, that's what I think about, is that how critical it is that you build these habits that will lay the foundation for your success. And if you notice, I'm not saying you build the system or you get the right system. I'm saying build the right habits. That's the most critical thing. So with that being said, I want to talk about every single week under this new, format that I've been going on for a few months now. I've been talking about one of my most recent trades. I've been talking about my most recent trade and what is, how I approach that from a purely price action perspective. And so I always pick a trade. I've been picking a trade generally each week and going over that and taking you through the exact process and steps so you understand the exact process that I went through in this trade, what I used from a price action perspective, and how I used price action to find this trade setup and give me this trade opportunity. And what did I use from a price action perspective to decide my stop, to decide my limit, entry, exit, the whole thing. So I'm going to take you through the same process that I went through within this most recent trade. You have to excuse me, I'm drinking a fair amount of water. One thing I end up finding myself doing in London was drinking a fair amount of scotch, because they have some good scotches here, being in the UK. And they don't get too many good scotches in Argentina, so I had a few last night. Really nice to just sit and sip on a glass of scotch, and yeah, exactly. It's important to stay hydrated after drinking, because alcohol dehydrates you, suppresses the kidneys, the adrenals. It's very important. So, okay. So one of the more interesting trades for me is the Euro Swiss. In fact, Swiss pairs as a whole have been very interesting to me. I've been writing about them for a long time. I've been writing since December 28th of 2010 that the Swiss franc is probably going to be the best winner in 2010, and it's going to gain the most against currencies as a whole. And that's what's been happening. Against every single pair from the G8, the Swiss franc is either at the all-time lows, making new all-time lows, or at the yearly or multi-year lows. It's just destroying everything across the board. If you had pretty much bought the Swiss franc against anything this year and held it from the beginning of the year till now, you'd be making a fortune. You'd be making thousands and thousands of pips. There's some currency traders at certain institutions that I know that sold the entire basket, and they are just killing it this year. And as we can see, just on this chart alone, the Swiss franc has advanced 1,600 pips against the euro. And so the Euro Swiss has been an interesting trade. It's been, something that I've been shorting and looking for continued shorts. And it's something that I will, keep watching for opportunities because the price action has been very smooth. And so last week, I was watching it, watched the market open. I'll take you through the process. And here's last week's price action. And here it is. It closed the week here, and it actually gapped down. And then, no, it didn't gap down. It did gap down. Went down just a little bit tad. Now, the gap down was consistent with market open. It gapped quite a significant amount, almost 100 pips. So for it to gap down, continuing the trend, go a few pips down, and then from there, climb very strongly to the upside after such a gap down. Not just filling the gap, but going way beyond that against the trend was a very powerful move. And then it followed the next day with some more buying. And for the next 5 days, it went on a nice little run. It went from 1405 up to 1889, 484 pips. That's a significant climb in 5 days. It did something similar not too long before that, about a month ago, where it is in the downtrend, gaps down, climbs up very strongly, climbs for the next 5 days, and then starts to sell off again. So I was watching this climb and kind of thinking that it's possible it may do one of these, pass beyond the 20 MA, and then once it comes back down, I'm going to look to sell it because I want to stay with this trend. I think the trend is going to continue. Until I see something that suggests that this trend is going to reverse, I'm going to keep looking for shorting opportunities in the Euro Swiss. And so here it is. It gains 3 out of 5 days in a row. Every time it sells off for a day, it just barely pauses or trots in place. So no real major effort from the sellers. And, more than likely, this was a combination of massive profit taking, but also some legitimate buyers coming in, likely central bank interest coming in to some degree. They've been doing it several times over the last 2 years. It's a pretty strong push. It doesn't really matter who or what. It just matters that, hey, it had a pretty strong push. And what I was looking at was, here we were last week. This is the close of the candle here. This is the start of the Monday. Here we are Tuesday. And it's just climbing again and again and again. And I'm thinking, well, let's watch and see how price action reacts around the 20 MA. The 20 MA has kind of been a barrier for this since way back here. And only once did it have a major breach above it. And it created what is called a with trend failure signal. And then it sold back off again, creating another with trend setup. And so I was looking at that saying, okay, let's watch and see how the response to the 20 MA. So what I did is, I said, well, wait a minute. Let's see if there's anything else here that might actually benefit our trade. So I pulled a fib from this last major down leg. And lo and behold, there was this nice little Fibonacci coming up. So price is climbing up through it last week, hits the 38.2, rejects off of it a little bit, but then closes right above it. And that wasn't because of the continued buying leading into this. I said to myself, instead of trading off the pure fib, let's wait and see how price reacts to the 20 MA. So here I am, and I'm saying, okay, let's see how price reacts to 20 MA. The next day, the market then does this. So here we are in that same fib move, and the market opens just below the 38.2 fib of this, climbs, goes down just a little bit, goes all the way up. It opens at, let's see here, 1754, climbs to 1889, which is 145 pips. So it opens, continuing all this bullish momentum that's there in the price section, climbs up 145 pips, and then sells all the way back down from 1889 to a low of 1694. So literally almost 200 pips. It's a 195 pip drop. So it climbs. Wait a minute. Hold on a second. I'm watching this. I'm sitting there going, wait a minute. This thing's been climbing since 1405. It's climbed a total of 445 pips, roughly. No, 484 pips. In one day, it climbs from the open 35 pips, and then slams back down 195. That's a very serious rejection. That's a very unique event. That's very odd, considering that it's been climbing for the last 445 pips. Whatever it ran into something that was very serious. It ran into either a small amount of institutions or a large amount of institutions. Doesn't matter how many. It just ran into some people who had a very strong belief that this was a great place to sell the Euro Swiss, and they put a lot of money on the line to do that. And you generally don't put a lot of money on the line to do something like that unless you've well researched it and really believed in what you were doing. So they put in a huge amount of money to sell this. Somebody came in at 1889 and said, that's as far as it goes. This fib level is as far as it goes. I'm going to sell it right here, and I'm going to put a huge chunk of money down the line, and we're going to sell this thing back down and slam it down in the face of a 445 pip climb. That takes a certain amount of conviction to do that. And so they did that, and they sell it, and the thing goes all the way down, and then it closes just below the Fibonacci, pretty much closing right where it started, saying, guess what, buyers? All of that buying that you've been doing over the last 4 days, the last 400 plus pips that you've been gaining, we're going to stop you dead in your tracks. And to me, that created a fantastic opportunity to sell this, continuing in the direction of the trend. So what did I do? In kind of a strange move, and this was a little bit unique, I said to myself, you know what? I'm not totally convinced that this thing is going to bounce back up, say, to the 20 MA. I would have liked to have waited to, maybe get a pullback to 20 MA. But here we are coming into the end of Friday. And I say to myself, you know what? I'm thinking I want to sell this now. Because if this selling pressure is that strong, that 135 pip advance, and then it stops it dead in its tracks in one day, drops it another 195 pips, you know what? I'm going to sell this. So right before the market close, I, with a little bit of bravado and generally counterintuitive, sold it right before market close. So the price is hitting right about here, and I say, you know what? I'm going to sell it. I like where it's at. I got the Fibonacci right here as resistance, plus I got the 20 MA. And if this rejection is legitimate, then I should have some really good protection on this. And what am I going to target? I'm going to target the lows back down here at 1400. So I said, okay, let's do that. So I did that. And Sunday, market opens, and literally, in this last candle here, represents, whoa, that's a little bit of a zoom. So this candle here represents Sunday and Monday's price action. The market opens Sunday, literally, doesn't climb 1 pip difference, opens and starts to sell off immediately from the market open. Here's what happens. It opens at 1750, and from 1750, thing sells off to a low of 1517 and closes at 1585. Now, I have closed my entire position, and I did it on this candle here, and I'll tell you why. It's very rare that I will close my position without going to my target. And oftentimes, in these situations, I have 2 targets where I have a first target and a second target. My first target was 1500, just a few pips shy of it, actually. I include the spread plus a few more pips. It was actually 1509. And so this trade itself, it's interesting because a lot of people are always asking me the question of, how long do you monitor your trade? And I'm going to get into that in a second. But the market opens up and pretty much sells off right off the bat, pretty much confirming that I had really good timing and I had a really good entry. And the fact that it had dropped from open to high to low 233 pips was also a very good confirmation that, I got in at the right time, that the forces that had sold this here and rejected this 400 plus pip advance were legitimate, and they continued putting the pressure on. So they continued putting the pressure on. That pressure continued right from market open. So, and thanks for answering that question. Yeah, the webinar is being recorded, and I'm using IntelliCharts. Now, I had been up to, from Friday, a couple hours before market close, all the way to Monday, early morning Eastern Standard Time. I had only been watching this trade a little bit. I had checked on it. I didn't check on it after market close. Actually, I did. I briefly looked at it just to shut down my platform. I said, oh, okay, we're fine. So then on Sunday, I just briefly checked on the market, and I didn't even check in on Tokyo Open. I just kind of checked in a couple hours after Tokyo Open, saw that it was selling off right at the bat, and I said, okay, great. No big deal. So at that point, when I had checked on it on Sunday, it was around 1680, and I was up about 70 pips. And so I literally at that point said, I'm going to move my stop to break even plus cost. So I included the spread. So if it comes back and kicks me out or something like that, no big deal. I'm not going to lose any money in this. But I'm up 70 pips, and that's enough of a buffer for me to feel confident that this is probably not going to return back to my entry point. But at least I want to neutralize all the risk. So I neutralized all the risk at this point on Sunday. Then on Monday, I opened up my platform, and I'm here in London, so I get to see the London Open, which is always nice to see the London Open in London. It just feels a little bit different than seeing it from somewhere else. So I watched the London Open, and my trade, let's go into a 4-hour chart. At this point, let's see. Here we are. Here's about the London Open. So this candle right here. It had just closed below the 20 MA on the 4-hour time frame. Very good sign. As you can see, here's the rejection on the 4-hour chart. Hits it, rejects off at massive selling. And sells off immediately from, here's the market open on right here. Open, sells off right at the back, closed below the 20 MA. And here we are, London Open pretty much. And it's still kind of around the high 1600s. And I'm like, okay, great. Market then begins to sell off pretty aggressively. And so I say, okay, and I wasn't like sitting there watching it every single tick or anything like that. I literally checked on it on London Open, and then I got ready for my day, and I come back a few hours later to check on it. And it's about the time where I'm about to go out and get my breakfast. I've already, showered and done my yoga and meditation for the day. And I just briefly look over my computer and call it a stroke of luck, call it really good timing. But I'm going to show you something very interesting. I'm going to tell you what happened, what I saw, and then I'm going to show you what it looked like on a 1-minute time frame. So I'm watching it, and price is actually getting close to my target. My target's at 1509, and it's just sub 1550 at that point. It's just selling. Everything is just totally moving exactly as planned. And then all of a sudden, and price action's moving. I'm watching the numbers just briefly, and price action's moving very smoothly. And all of a sudden, I see it hit the 1554, and it just happened to be that I looked at it 5 seconds before, and all of a sudden it hits it, and then price action, instead of moving very smoothly, all of a sudden got really erratic. It jumped like 8 pips up, and then it kind of stalled for a second, and then climbed right back down to 1554, and then all of a sudden it jumped in like a tick. It was literally just a question of a tick. It literally jumped 20 pips, and the price action movement was so strange. The numbers, the way they were moving was so strange. I was like, wait a minute, that's not normal. And again, one of the things I'm always looking for is abnormalities in the market. And so I said, wait a minute, that's not normal at all. Why would price action all of a sudden, something that's been selling so smoothly, have like a quick 7-pip jump in the London session, which is quite liquid, bounce back down, and then have a 20-pip jump in a matter of like a tick or two? And so immediately I started to think, okay, maybe algorithm or, some big player came in, but I said, something is really strange about this. It was not normal by any means. And so I said to myself, you know what? I'm just going to really briefly prop in to the 1 minute time frame, and I just want to see what it looked like. I kind of knew what it would look like in my head because I was able to see the numbers, and when I saw the numbers, it kind of created a visual in my head of what was actually happening. But I said, you know what? Let's take a look at it just for a second. Not that I wanted to do some analysis, more of like I just wanted to see what was it that caused that strange move. And, oh shoot, I might have to go back a little bit. I think I have to build a custom chart. Give me a second. Oh no. Oh no. My 1 minute time frame may not go back far enough. Let me see. We're past 24 hours and I don't think it stores more than 1 minute data past 24 hours, which means I can't show you. So what I'm going to do is I'm going to have to show you in a 5 minute. My apologies. If it was only a few hours back, maybe the 3 minute chart. Where is the 15? Oh yeah, I think this is it. There we go. Okay. So we're going to look at this on a 3 minute time frame. I know we're going to look at this. But it was more of like a curiousness. I wasn't trying to analyze anything. I just wanted to see for myself, what did that price action look like? Keep in mind, here we are. We're selling all the way down from 1710 in a very rapid advance, all the way down to just constant. I mean, you only see a few blue candles here, but even this last leg was just super strong. 1640 down to 1554. Literally 90 pips in not even an hour. And then all of a sudden, and in 3 minutes, it goes from 1554 to 1667 and then just climbs up. And I said, you know what? There's something really abnormal about that. And so I said, you know what? I don't like that. In the sense of, for this thing to be at maximum selling pressure, almost maximum selling pressure, selling a total of 3, 6, 9, 12, 15. Out of 45 minutes to be selling 42 of 45 minutes straight. And then to all of a sudden have a 6-pip jump in one tick and then come back and then jump 20 pips in a matter of minutes. To me, that was really strange. And so it communicated to me something very serious. Again, algorithm, whatever. There was no news at that time. I was checking. There was no news at that time. But something very serious came into the market. Because, I was checking and I'm like, no, there's nothing really news going on. Why? So what's going on? Something really serious came into the market and rejected it. Just like the same thing that happened to the upside. Something very serious, put a lot of money down, rejected. But this was a little bit different. It wasn't just the seriousness of it. It was the oddity that it moved in such a quick succession that communicated to me, something's very wrong about this. Get out. And I can't really say that it was all technique that did it. It was a combination of technique, but it was also a combination of just experience. I've been looking at charts for 10 years now. I've seen a lot of price action. I've seen not just price action from the physical representation of what it looks like on the chart, but I've seen a lot of numbers move, just sometimes watching the numbers move on your platform. And I've seen how price action those numbers move. And with that being said, it didn't matter to me whether it was an agent coming in or China buying your USD. None of that mattered. News, none of that mattered. It was just extremely odd, and it reeked and it smelled and it had the odor of something very odd. And everything about it said, get out. And so I said, you know what? Okay, I'm going to get out. Normally I don't like to get out before hitting my profit target, and I hadn't even taken profit off the board at that point. But I said, you know what? That's okay. I've neutralized all the risk. I got in at 1760, and here it is, 1560, 1562, 1563. So I'm roughly up 200 pips. Not a bad day, and let's close it out. And so that's it. Since then, it's been being bought up in a relatively lackluster fashion, but does have some downside rejections, and it's running into the 20 EMA. But the fact that it's been bought up, 16 out of 24 hours, in a lackluster fashion, doesn't tell me that the buyers are super committed until they take out the 20 EMA. This will either say, hey, it was a really good decision, or you got out a little bit too early. But normally, the reason why I'm saying this is normally, just because I run into something and run into a little bit of resistance or support, depending on the direction, doesn't mean I'm going to get out. Maybe maybe I run into a bounce that's 50 pips counter direction. And whether I was up, the fact that I was up 200 pips at that point didn't mean anything. I wasn't looking at this like, oh my God, I just lost 20 pips or something like that. I was looking at that more of like, that is extremely odd. And when I run into these oddities, that's when I kind of say, whoa, wait a minute, something different is happening here. Reevaluate. If it's nothing really odd about it, then no big deal. And one thing I did to check to make sure it wasn't just my broker was I looked at another broker just to make sure. I just checked my other broker's chart real quick. Same thing. He was having the same thing. So with that being said, I said, you know what? It's confirmed. Something odd happened, and I'm out. And that's it. Not too bad. Ended up about 193 pips or something like that, just under 200. And that was it. So that was how I made this trade decision from beginning to end. And with that being said, I want to real briefly go over my final entry, which I've already communicated about, what I used as my stop, what I used as my limit, how I made those decisions from a price action perspective, and then we're going to get into some questions. Okay, so you all know, just to recap, the basics of the entry. Of course, I was looking to continue to get back in the downtrend. As many times I've said before, I like to get in on pullbacks towards the 20 EMA and rejections off the 20 EMA. I like to get into those. And all of those things, were coming into play. But the real thing that triggered the entry, the real thing that really kind of capped it off was, hey, you know what? Opened up at the fib. We've been climbing now 400 pips in a row. In one day, we advance 135 pips. And then when we get rejected at the 50% Fibonacci, just sub at 1900, and sell off 145, 190 pips in one day. That can be indicated to me the market ran into a very stiff resistance, and some players are very serious about selling this, so I'm going to get it. It closes right below the 38.2. Perfect. I'm going to get in here right below the close. And then I'll get into some of the questions around, because I know you have questions around that. What was my stop on this one? I was debating between two stops in this one. I was debating between stop A, which is just above the 20 EMA. If the 20 EMA really is going to hold it, then maybe I should just put my stop above the 20 EMA. My entry was 1763, just below this Fibonacci here. No, sorry, 1754, my apologies. So right about there. Okay? There's my entry. I have the fib and the 20 EMA offering up this projection. I was debating between this stop A and stop B. Stop B was just a few pips above this here. Why stop B is an option? Because because price had advanced here before, it is possible that it could pull back and really want to test this resistance here. And in doing so, if the players here were very serious about rejecting it here, then they should come back in and reject it again before we get back up here again. So these are the two options that I used. I ended up going with stop B. And the reason why I chose stop B over stop A was because the 20 MA was breached before in the rejection, I wasn't totally confident that it may hold the upside rejection but still be breached again. So then the question became, how much would I put it above there? On top of it, I would be in between these two Fibonacci's here, and that wasn't exactly a good zone for me to do it. So I said to myself, you know what? I believe that this will hold. And to be honest, I never really thought it would get past the 20 MA. But if it did, it had the potential to breach it by X amount of pips because it did the last time. So I couldn't necessarily use this as a perfect line in the sand. But I did feel confident that this wasn't even going to come close to get touched. Now, many of you may be thinking, well, shoot, that's the problem with trading on daily charts. That's 140 pips. I can't handle 140 pips. That's just an excuse. There are so many different size accounts today that you can position size in such a degree that you can reduce your risk down to a few percentage points. So they have mini accounts, and for those of you who don't have large enough accounts, and they have micro accounts for those of you who don't have large enough accounts. So it's just an excuse. There are the account sizes today that can certainly allow you to trade 140 pip stop where you're only risking a couple percent. Again, it's not the pip size that matters, it's your position sizing. Doesn't matter whether it's 30 pips, you could have really big position sizing and be risking 10%, or you could have a really large stop and risk very little via position sizing, and it's no big deal. So no excuses about that anymore. So with that being said, that was my stop. When I've told you before, when the market got past here, this is below this low here, that's when I brought my stop to break even. I was already up 70 plus pips at that point. Now, why did I choose this as an original target? I actually chose just above 1400 because I wanted to choose just above this here in case buyers came in a little bit early. Why was that my original target? That was my final target because usually in downtrends, when the market has a sell-off, pulls back to retracement level, and then sells off again, it usually does return back to the 0 point of where the bounce started. Usually. Not always, but usually. So I said to myself, very likely it's going to return back there. I did have a first profit target originally of just above 1500, 1509 as I stated. A few pips above 1500, round number, and that was that. So that was my first profit target, where if I clipped that, I would then, take profit off the board and advance the stop to plus a certain amount depending on how the price action played out. But as I've already explained, I showed you how this trade worked out, how I saw that very strange form of price action, something that wasn't unique. And again, it had nothing to do with the fact that it bounced 20 pips. I wasn't sitting there sweating going, wow, that's 20 pips. So I'm down. I lost 20 pips of my, 200 plus 200. I better get out. This is a real rejection. That wasn't what entered my head. The thing that entered my head was the strangeness about how it did move that 20 pips in such a short period of time and how it was jumping several pips at a tick and jumping up, down, up, down, up, down. It was just very, very strange. It wasn't like it ran into a wall and then just started bouncing. It was just very odd, and it moved in a very odd fashion. If I had to guess, it reeked of algorithms or something like that. But it doesn't really matter who it was, whether it was China, Asian buying, news, central bank, none of that mattered. The fact of the matter was odd, and it was the oddness that communicated to me through all my experience, get out. And we'll see whether it was a good decision or not. If I was wrong, hey, I lose another 140 pips. If I was right, I could have saved myself 190 pips. So with that being said, does everybody get how I made the decision based on all the price action, based on all the things that I'd said leading up to this, how it all set up, how I chose my stop, how I chose my targets, how I chose my entry? Does any of all this make sense to you guys? Does that make sense on how and why I chose all this? And does that help you understand, how to trade price action? Good, I'm glad it helped because, I find if I go through these examples step by step, that, by seeing how I do it step by step, you get to see all the subtle little details. And I would like to communicate one thing, which is that, again, I keep getting the questions of, how much time did you spend monitoring this? If I was to add up the total amount of time I spent monitoring this, once I entered the trade, if I was to tell you how much time I spent monitoring this, we're talking a whopping 45 minutes max. And that's opening the position on Friday towards the market close and all the way through Monday morning. Not much time at all. Very little time. That's the total amount of time I spent at the computer from the moment the trade was open to the moment it was closed. Which shows you don't have to spend a lot of time behind the computer when you're trading. Once you remember, all of your thinking, decisions, and everything, 95% of that should be done before the trade. The only time you should really be making the only time you should be making any sort of real thinking about it is when something really odd happens. If nothing really odd happens, then there's no reason to be watching it. There's no reason to be sitting there glued to it. Because chances are, if you don't have the discipline and the mental discipline to be able to not make judgments about your trading, about yourself, about the market, about the position, about anything, if you're not able to do that, then being in front of the computer will not help. It will cause you to more than likely make judgments or decisions or anything about your trading that can actually affect you doing what you originally set out to do. So that's why I don't recommend spending too much time in front of the trade, no matter what kind of time frames you're trading, whether you're trading 4 hours, dailies, or 1 hour, it doesn't matter. So that's my thoughts on that. Now we have a ton of questions. So let's get into some of these questions. So going way back to Nizam's question. What makes different method works for different trader? Is it the type of trader you are? It's a great question. It usually depends on not the type of trader you are. It really depends on the type of person you are. And there's several ways to go about finding which is what are some of the better methods for you to trade. One of the ways to do that is to just experience the market. Practice a lot of demo trading, or maybe even practice live trading with a very small amount, and just start trading the markets and try different various methods and see which one makes sense to you the most on an intuitive level. Like when you hear it or when you see it or when you look at it, you're like, wow, I want to trade that. That feels like something I want to trade. I like the time frames. I like the way it works. I like the fact that it has indicators or no indicators like price action, or I like being able to, trade off these levels or use this or use that. It should be something that just feels natural, that makes sense to you. You don't want to force yourself into trading a certain way because you look at it and you're like, oh my God, that looks like it makes so much money. I want to trade that. It's the wrong way to be doing it. It would be like me it'd be like as I'm learning to become a professional archer to say, oh, I want to shoot that bow because it just looks so cool. And it's just like, come on, that's ridiculous. It's just totally ridiculous to try and trade that way. So it's important to understand who you are. And maybe more than likely, you don't fully understand who you are, especially when it comes to the world of trading. Because the world of trading, psychologically, is going to activate a lot of things about you. Trading is not a you versus the market thing. That's completely ridiculous. The market doesn't give excuse my language, and this is being recorded, but the market doesn't give a shit about you. It doesn't care about you at all. It doesn't even know who you are. In fact, a lot of times your accounts are anonymous to the interbank market. More than likely, if your broker has pass-through trading, pass-through execution, your account is anonymous to the broker. They have no idea who you are. The market is much larger than you. It doesn't care about you any more than the ocean cares about you swimming in it. And so with that being said, it's not a you versus the market. It's not you versus your broker. Most brokers today got pass-through execution. And if you don't, then get with one that does. You can take that excuse out of your excuse box. But trading is a human endeavor. It's a you against you. The only person that's making decisions to buy and sell is you. If you decide to choose an analyst picks, that's your decision. If you decide to put the stop and limits there, that's your decision. If you do it based on your analysis or someone else's analysis, that's your decision. If you decide to adjust your stop or get out of your position too early or, close your thing or do if you decide to do any of those things, it's your decision. Trading is a human endeavor, and it's an endeavor that will challenge you to understand yourself and find out more about yourself than you probably never had anticipated or imagined. It's going to force you to understand things about how you think. How do you think about charts? How do you think about the markets? What's your perspective? Do you have a bias? Do you have no bias? Do you have faults or conditioning around money that could severely influence your trading? Do you have financial issues right now or challenges that may be influencing your trading? Do you have bills that you're trying to use this to pay for? Will that influence your trading? Are you worried about paying your bills and those things? All those things are going to be present in your trading process. Trading is a human endeavor. It's not a us versus them or us versus this ambiguous market. It's a human endeavor, and the only thing you're fighting against is you. And so sometimes you have to find that out through the process of trading. More than likely, anybody who ever becomes really good at any sort of skill finds out a lot about themselves. And I'm learning that through archery. I'm learning a lot of information about myself and how I learn and what kind of person I am just through archery. And it's the same thing through trading. So with that being said, it really depends on who you are as a person and what your strengths and weaknesses are, both psychologically, discipline-wise, all of that. Okay, so hopefully answers your question. It's a fantastic question, Azam. Lewis says, why see the last candle bullish green on Trading Station and MT4 platform? Because there's probably on different time servers. Webinar is being recorded, yes. Platform views and intelligence. Minosh says, and this is a good question here. If you're selling Euro Swiss, do you look to see if the other Euro crosses are looking bearish too for confirmation? I don't look at the other crosses for confirmation. This trade setup is its own unique entity. And yes, they can have an influence, but I'm not looking at that for confirmation because what's happening in the Euro Pound has probably very little influence on really what's happening with Euro Swiss. Euro Swiss is really a question of what is the market's relationship between the Euro and the Swiss franc? Do we believe the Euro is going to continue to strengthen or weaken against it? Is this trend going to continue? And if anything, if I was going to do any comparison, not confirmation, but comparison, it would be a question of how is the market reacting to the Swiss franc? And we already know the answer to that. The Swiss franc is just destroying everything across the board. So I really didn't need to look at any other pairs to confirm this. I just knew already, hey, the Swiss franc is destroying anything. What else do I need to compare or confirm? There's nothing else. But even if I didn't know that, I wouldn't be looking at that for confirmation. I will be trading this on its own pure price action signal. So hopefully answers your question. Jack 1 says, dollar Swiss may be close to 78.70 bottom. If Euro USD jump up, would Euro Swiss bottom up on price action? Let me see. If dollar Swiss may close, dollar Swiss on 78.70 bottom. If Euro US dollar jumped up, would Euro Swiss bottom up on price action? Who knows? It's one of those things. It could not. People may be there may be people invested in Euro Swiss that have their own perspective, and it doesn't matter regarding dollar Swiss. They're really concerned, how does the euro relate to the Swiss franc? And so with that being said, I would say it could, but the most important thing is that you watch and see how it relates at that time. That would be, that's why it's important to be able to do price action analysis in real time. So hopefully answers your question. Great question, though. Manotis has another question. Chris, the 20 EMA on the 4-hour chart, is this a signal you've noticed yourself, or is this used in the Forex institutions generally? Both. It's something I've noticed through the last 10 years, but I know Forex institutions that are commonly using, just the 20 EMA. In fact, I know, there's this great story that the former, what you would call chief technical analyst, or the biggest technical guy at the CBOT, I met him once, and it was funny. I was expecting to see all kinds of things on his chart, and he just had one EMA. That was it. And so, it's 20 EMA is something that's commonly used in institutions. So hopefully that answers your question. And if you just watch it long enough, you'll see how price action relates to it. William, Chris, do you normally like to open on Friday or hold a position over the weekend? Is the event risk worth it sometimes? This is an excellent question. I'm glad you asked it. I knew this question was going to come. Normally, no. 95 to 98% of the time, I will never open a trade that close to the market close on Friday. It's so rare. In fact, I'm usually out of positions over the weekend. I'm usually out of positions by the London close. So the answer to that is generally no. This was an odd, unique event, and I felt comfortable with the event, and I felt comfortable in the price action that it would, in my price action analysis or understanding of it, that this would continue. I also felt like, hey, if the politicians in the U.S. continue to play political games and not figure out a way to solve the debt, which I didn't think they would, the whole debt ceiling issue, then that's going to create more event risk in the market. And what will that do? Cause more dollars to flock into the Swiss franc. So with that being said, to me, it wasn't really that much of a risk. It was a pretty calculated risk. Generally, I would say I wouldn't recommend doing it. Is the event risk worth it? Generally not, especially in this volatile environment with the huge risk that's out there, with all the problems in the global economy, with the situation with the debt ceiling, how sensitive an issue, possible QE3 and Eurozone debt crisis and all this. No, I generally wouldn't want to. But again, I was only risking a couple % of my account, so it wasn't that big a deal if I lost. So hopefully that answers your question. Jack says Asian come in, China buy. Could it be market makers? Again, none of that really mattered. It just didn't matter. It really didn't matter. What mattered was the oddness of it, the unique price action environment, signature behind it. That was what mattered. Miguel says, hey, what's the number of the moving average, please? It's the 20 EMA. So hopefully that answers your question. Sony Walkman, do you use closing stops or intraday stops? I'm not sure what you mean by intraday stops or closing stops. If you could specify. I pick my stops based upon, hey, this is where I think at this point I no longer want to be in the position. At this point I will consider myself to have wrongly, assessed the situation. So at this point I want to be out of it, this level. And at this point I want to take profit. Nothing to do with intraday or anything like that. It has to do with price. So hopefully that answers your question. Okay, next one here. Did you use any other indicators shorting Euro Swiss? None at all. 0 indicators. Pure price action. That's why I used it for this class, because this class is all about pure price action. I shared with you all the analysis and techniques and all the things that I did in analyzing this. That was it. I didn't use anything else, no other indicators, no nothing. And that's the beauty of trading price action. So hopefully that answers your question. Okay, we got a couple more minutes, and then I gotta get going because I think there's another class here. What about euro dollar? Is it more difficult to trade at any time frame? Is it more difficult to trade at any time frame? It's kind of a ambiguous question in the sense of, is euro dollar more difficult to trade? To be honest, I would say it's a little bit more challenging to trade because there's more interest in it. But and I have to get going because that's the curtain call. But I find Euro Swiss to be a little bit smoother because there's generally a lot less manipulation. It's pretty smooth, especially when you look at it, over a longer time frame. It looks just super smooth. And euro dollar, in and of itself, if you're just looking at euro dollar can be harder on some time frames and easier on others. I generally find no matter what the currency is, though, no matter what the instrument, the higher the time frames that you're trading, the better that, the much easier it is to trade. You tend to get a lot more accurate information. It's a lot smoother. Price action setups work a lot better. And I generally find that when traders move up on higher time frames, they tend to have greater accuracy and consistency. That's not always the case, but it's generally the case. And so hopefully that answers your question. Okay, I have to get going. That's the end of it here. So thank you all very much for coming. Please stay on for the next class. I believe Sam Simon's coming on, and fantastic trader, so please stay on for him as well. And that's it. So I want to bid you all adieu. I wish you all good luck trading. Any questions, don't hesitate to check us out, secondskysforex.com. Until then, good luck trading, and I'll see you guys next week. Take care, everyone.